Hello guys, today we're going to just look at basics of our money system in the United States before we hop into the macroeconomic side of it, which is monetary policy. First, we need to just understand what banks are, how they operate, what they do with interest rates, and what the Federal Reserve is, which is like an arm of the government when it comes to how much money is in supply in the United States. So our I can statement is I can analyze banking and interest basics. So we're going to start with banks and what they are. I'm going to give you the short run of it here. So basically, banks own our financial assets in cash, in electronic money, in gold and silver, all those things. They hold people's money. So people go and deposit money in the bank, and the people who deposit money in the bank are called depositors. So that's what I mean when I say depositors. And banks also give out loans. They give out loans to businesses to start businesses or further their business. They give out loans to people like school loans or house loans or car loans or renovation loans, anything like that. If you need to borrow money, the bank is where you can do that, okay? So how do banks then, because most banks are privately owned, how do they turn a profit? Why are they even in business? They make money by taking your money and loaning it out. So banks make a profit by taking a depositor's money, someone who puts money in the bank, and they loan it out to other people. And until that loan is paid off, they are making interest. So if you borrow money from a bank, then you are not only, let's say I borrow $20K to buy a minivan. I'm not only borrowing $20,000, I have to pay more money to borrow that $20,000. And that's called interest. And we'll get there in a second. However, banks are required to keep a certain percentage of money deposited, and that's called the reserve requirement. And that's so that there's always a reserve of money in the bank at all times. And it hovers around 10% of money that is taken in must be kept at the bank, and the rest can be loaned out. So that's like 90% of money that's being loaned out. And the reason that banks are required to have a reserve requirement is in these financial panics and recessions, and ultimately the Great Depression, before the financial system was really solidified in the United States, we would have what was called bank runs. And here's the definition right here. It's when people were fearful that a bank was going to close and they ran to the bank and took out all their money. Well, the bank didn't have all the money. Remember, they take your money and they loan it out. So the last people in line would get up and say, "Can I have all my money?" They'd say, "I'm sorry, we don't have any of your money." And that money was just poof, gone, vanished. And people lost their entire life savings in these bank runs, especially during the Great Depression. So the federal government steps in and requires what's called a reserve requirement now, meaning that the bank has to keep a portion of what people deposit. And also nowadays, our money is insured in the bank through the Federal Depositors Insurance Corporation. So if the bank closes, your money just doesn't disappear. The federal government will insure your money and get it back to you. So banks make a profit through interest rates, but they also create new money. And I know you're thinking, like, how do they create new money? Like, money is printed in the U.S. mints. Well, think a lot of this stuff is done digitally, electronically these days. And we call this the money multiplier effect, where they create money. And banks always bank on what is called fractional reserve. And that's exactly what I just explained to you on the last slide. When they hold a portion of the deposits, the reserve requirement, and then loan out the rest. So it's not always 10%, but it hovers around there. And their hope is to make a profit on interest. Well, when they hold that 10% and loan out the rest, the person that they loan that money out to goes and invests it in a business or buys something. And maybe that person goes and it deposits it in a bank. Well, then that second person who's deposited money in the bank, now the next bank, the second bank, holds 10% of that money and loans out the rest. So it's just this constant cycle of holding some, loaning out the rest, holding some, loaning out the rest, holding some, loaning out the rest. And eventually it creates new money. And you guys are going to be watching a video at home or in class all about the money multiplier effect. So I'm not going to get too much into it. And that's this video right here. Okay. But essentially, let's take a look at it right here. Let's say we have 10 banks, and I'm not going to go through this whole thing. We have 10 banks and a different different people are borrowing money from all these banks. The first person deposits $100. Okay, so person one goes to bank one, deposits $100. Let's say the reserve requirement is 10%. So then bank one loans out $90 and reserves $10. Okay, their total reserves are $10, and the money in the system, and when I say the money supply, I mean the money that's in people's pockets and the money in people's bank accounts, is 100. Well, then this person number two, who borrowed $90, gets that $90 and deposits it in bank number two. So when they deposit it in bank number two, now bank number two has to do the math and take 10% of that $90, and they have to keep $9, and then they loan out $81. Well, all of a sudden now we've got a reserve of $19, and we've got money total at $190. So you see how from bank one to bank two, they created money by loaning it out to another person. Well, let's say person number two that deposited their money, someone goes out and at bank number three, deposits that $81 that they borrowed from bank number two. That $81, we got to do the math, 10% of 81, okay, is $8.10. So bank number three takes that $8.10, puts it in the vault as reserves, and loans out the $72.90. Well, all of a sudden, we had $90 loaned out, $81 loaned out, $72.90 loaned out. We have created a bunch of new money. Our money supply went from that original $100 to now all of a sudden we have $271. That is the money multiplier effect. I'm not going to go through the whole chart. All right, let's talk interest rates, how banks turn a profit. An interest rate is the cost of borrowing money, okay? It's a fee paid by someone who borrows money paid to the institution they borrow from. So you will pay them back the money plus interest, and that's the cost of you borrowing that money, and that's how banks make a profit. So if I am borrowing money, I want a low interest rate because I don't want to have to pay a lot more than what I'm borrowing. But if a bank is loaning out money, they want a high interest rate. Sometimes, we'll get to that in a minute, because that means that they're not only loaning out the money, but they're going to get it back plus a lot more. And when we're talking about interest rates, there's two words you need to know. The first one is principal. Principal is the initial amount borrowed. So that would be like the $20,000 to buy a car. You borrow $20,000 to buy a car. And then the interest, or the compound interest, that's the second one you need to know, is the interest calculated from the principal, and it's added on top of the loan. So interest rates right now on cars are sitting about 3 to 4% if you're going to get a car loan. Sometimes houses, interest rates right now for houses are really good. You can get like a 2.75 interest rate on a house right now. Sometimes, like during the great housing crash, there's a 7% interest rate on houses. That's not good. Credit cards sometimes have awful interest rates, because when you are swiping a credit card, you don't actually have that money in your bank account. You are borrowing money from the credit company in order to purchase that good, and you're going to have to pay that money back plus interest. Some credit cards have an interest rate of 25%. You're going to pay a fourth on top of what you're already paying. So that is the compound interest added on top. So let's go back to my example. I borrow $20,000 for a car, and they slap on an interest rate. Let's say the interest rate adds $3,000. I'm going to end up paying that, $20,000 back plus the $3,000, and all of a sudden I paid $23,000 for that car, not just $20,000. So that's kind of how interest rates work, okay? So when it comes to the macroeconomy, large-scale economics, when interest rates are lower, more people will take out loans. And people take out loans for school and cars and houses and small businesses and big purchases and renovating their houses, all those sort of things. But banks make less if interest rates are lower. However, do they really make less? Because if interest rates are low, more people will borrow. And if more people borrow, then more people will go to the bank to get a loan. So they're not really making less. It's just less per person. But more people are going to be borrowing because interest rates are low, okay? And this is really good for the economy because, remember that money multiplier effect? When people borrow money, it creates new money in that cycle of depositing and loaning out, depositing and loaning out, okay? When interest rates are higher, less people take out loans banks make more, but they're making more per person and they're not really lending out that much. So higher interest rates slow down the economy because less money is being created, less people are borrowing money and investing it in cars and houses and small businesses and student loans and things like that. All right, so let's look at the piece of the puzzle that regulates all of this, and it's called the Federal Reserve. The Federal Reserve was created in 1913 with the Federal Reserve Act during President Wilson's presidency to try and stabilize the banking systems and prevent the whole bank run thing. Now, they didn't do a great job because remember the Great Depression is in the 1930s, and the Federal Reserve was very slow to act there, but it's actually pretty effective today. And the whole hope is if the government backs up the financial system, more people will put money in banks, more people will have confidence in the banking system, more people will invest in small businesses and take out loans, and that will help our economy as a whole. If people just feel confident that the federal government's got your back when it comes to banks. There are three parts of the Federal Reserve. The Board of Governors kind of makes all the big decisions. The Open Market Committee, which is what we'll be focusing on. And then 12 regional reserve banks. So actual brick and mortar banks that we'll get to their purpose here in a minute. So a long list of what the Federal Reserve does. Basically, they supervise banks. They take care of clearing checks. They take care of wiring money. They maintain the U.S. government money. They help the U.S. Treasury. They will transfer money between banks. They'll deal with customs and currency ratings and things like that. They will lend out money to banks that need help. They will help strengthen banks that need help. It's just there to be a support system for our entire private banking system. Okay? So what do interest rates have to do with the Federal Reserve, sometimes called the Fed? So if you hear me say the Fed, that means the Federal Reserve. There are two terms you need to know here. The federal funds rate is when banks loan money to each other, and it's the interest rate, the cost of borrowing money from another bank. So if one bank is failing, they might go to another bank and say, can we borrow money really quick and just get back up on our feet? So that kind of changes what the failing bank is able to offer people in terms of loans and interest rates. Because if bank number one is really, really strong, bank number one is strong, and bank number two is failing, bank number two might go to bank number one and say, hey, can I have your help? I really need some money to make sure that I don't go under. And bank number one's like, cool, yeah, that's fine, but I'm going to charge you a 25% interest rate. Okay. So bank number two borrows the money from bank number one at a 25% interest rate, which is just exorbitant. Now bank number two is not just going to eat the cost of that. Bank number two, when it comes to loaning out money, if it's going to loan to Joe Schmo over here, if he is loaning out money, if bank number two is loaning out money to Joe Schmo down here, he's going to charge more than a 25% interest rate. He's going to charge like a 35% interest rate because he wants to make back what he spent borrowing the money here. Bank two has to make back what they spent borrowing money from another bank. So that's the federal funds rate, the cost of borrowing money between banks. The discount rate is the cost of borrowing money from the Federal Reserve. So oftentimes, the Federal Reserve will, if a bank is failing, prop up that bank with money and hopes to keep the discount rate low, because when they keep the discount rate low, the bank that's borrowing money can keep their interest rates low, and that will stimulate the economy. And we're going to focus more on the discount rate. All right, so just like I explained on the last slide, when banks borrow money from each other, that's called the federal funds rate, or from the Fed, that's called the discount rate, they don't just like eat the cost of that. Instead, whoever is, like in my example, bank two was going to loan money to Joe Schmo, they're going to charge Joe Schmo more money, a higher interest rate, to make back the money that they spent borrowing from another bank, and maybe even make some profit, okay? So even though borrowing money is expensive, even though it might hurt the consumer a little bit, really it benefits the economy as a whole because the Federal Reserve makes money from the interest rate of loaning to bank number two. The bank is making money because they charge a high interest rate to Joe Schmo. And Joe Schmo goes and generates economic activity with that money by buying a house or buying a car. I'm going to try and draw a car. Hey, that was pretty good. or going to college or anything like that. So when Joe Schmo uses the money that he borrowed from the bank, now he's using it as consumer spending or investment spending. My friends, remember when we talked about this at the beginning of the unit? Consumer and investment spending, an increase in those leads to an increase in AD. So overall, interest rates, not fun, but they really help and benefit the economy. All right, that's all for today.